yeah, as well as the form that is, of course, the website. So, of course, be glad to join us on that particular side of the conversation. Do stay locked on. Mutwale, how are you today? How's your morning?
Good morning, Vernon. Good morning, and it's been an interesting morning. It has been.
Yeah.
I think we have been trying to go through some stories, but firstly and foremost, Vernon, in as much as it's interesting, it is the midweek.
Mm.
Let me run through the markets after a very interesting day where we had visits and state visits and speaking arrangements with the IMF director who did give her words when it came to Zambia. Let's go through some of what the data, what some of the data is transpiring. Number one, our FX rate has not stopped devaluing. We are now on the 77th day of consecutive kwacha losses. We have seen the kwacha move down about zero. The dollar is up by about 0.66%, and now at about 18.7699 on the interbank rate, which is the wholesale dollar market. Currently still trading above its 200-day moving average with signs that it is overbought and it's supposed to be slowing down. But we are not seeing this continue. So we are losing about 1% a week on the value of our currency, which should actually lead to what we call imported inflation in the cost of goods that are being imported and brought into the country. So that's the concern, obviously, right now. And this is basically all the gains since the administration came into power. So 77 days of continuous kwacha losses. It looks like we're probably going to close up somewhere very close to 100 days of the currency losing value, making this obviously the second. Currently, this is the second longest losing streak of the currency. When we're looking against the rand is down, is had zero losses yesterday, and we did see that the rand on the week has lost value by 0.41% versus the dollar that's actually gained value of 1.39%. So still being in a defensive posture is the right way to go. Mainly looking at the commodities market, when we actually drift into it, we did see that copper dropped yesterday by about 0.17%. One of the main things that came down yesterday was manufacturing data around the world. And here it actually reflects in the oil price. It says oil and commodities 2-week rally paused meaningfully for the first time on Tuesday as prices fell by almost and action in U.S. manufacturing reinforced fears of a recession. Yeah, there we go. Sorry about that. That reinforced fears of and the expectations. A recession economy and relatively high inflation.
Seem to just have.
We did see. Yeah, sorry, we do seem to be having a little problem here. We did see oil prices start down as well by 2.34%, mainly because we were seeing that U.S. crude piles also started to rise for the fifth consecutive week. So we are seeing a lot of price rises on the market. We did see oil price drops on the market. Now, as we were getting recession fears coming in, one of the big things we're also seeing is that gold prices went up by 0.52%. Up obviously 6.15% in dollars year to date. Why? Because of recession fears. So recession fears are starting to pull down copper prices, pull down oil prices by much more, and also we're seeing gold prices going up. So that's why I said the defensive posture. Best investment strategy. Now, obviously, we did see yesterday the main news was IMF conversations and so forth. But going into some of the main, we did see this on our what's it called? Our 5 things to know. Now, I know that obviously backstage, we have had how do I say this? A spirited conversation. These are my colleagues. We are a family people. And the good thing about the intellectual community and the professional community is that when we disagree, we still do it with grace, with one another, and absolute respect for one another. Okay? Whether we disagree or not, it's always going to be with grace and respect. I'm going to read an article to you, Brennan, which does concern me from perspective here that has to do with us in the country present information. And one of the reasons why we tend to get things wrong a lot. She did write to me
We seem to have
what we call the
connectivity
function.
issue today. I don't know if you're able to hear me loud and clear.
We're just having, unfortunately, there are days when our networks decide that they just want to act in an incorrect way. But what we call the functioning illiteracy problem. And just to get down to the crux of it, this article that was written, and I'm just going to paraphrase it because I'm just struggling to find it at the moment, did say the following things. It did say, in Zambia, we don't speak in specifics. This is our core problem comes as a people. We don't to speak in specifics. We like to speak in this. We'll say things like the Kariba has significant amounts of water instead of saying the Kariba is 70% or 80% full. Okay? We'll say prices are really high instead of saying prices have X%. Okay? We'll say things like this Zambia has a lot of mineral resources instead of saying Zambia has X amount of metric tons in reserve. Okay, we don't speak in numeric specifics, and this is why we always find ourselves in problems. People are not measuring the Kariba because we're speaking in lot, little, slightly smaller. We're not saying 50%, 40%, 30%, because those things help us actually make policy. See, one of the reasons why we use numbers and mathematics is because it helps us create policies and assess directions. That's a very important thing that we should be doing as a society. But unfortunately, we speak in vagueness. And it's also because our politicians seem to always be leading the charge and always speaking in non-specifics, which are often used to just purposefully confuse people. Why are we saying this? Well, I'm going to start with, I think it was a third article today on the statement on a statement that was actually brought on in our 5 things to know. And I'm going to specifically jump to this one on point number 3. And over and over as a country. Now, in our 5 things to know, it did say that an economic analyst challenges the Zambia statistics to clearly state the basis for which the inflation rate is being calculated when commodity prices continue to increase. Okay, this is the problem. Okay, the reason I'm saying this is a problem, there's a lot of problems just in that statement alone, because it's misrepresenting what the inflation rate is. The inflation rate, Vernon, is not evidence. Yeah. And this is the problem. This is why I'm going to stand against this. And whoever's, like I said, whoever actually said this should answer for it. Okay. And I know we haven't stated the economist's name. And until they're willing to come forward, let's actually have the context with which they said that in. Because I'm going to hope that there's more context to that statement than the actual bland statement, because that is a misrepresentation of what an inflation rate is. Let me tell you why. The inflation rate, Vernon, in Economics 101, you are taught this. The inflation rate is not the rising of prices, but the speed at which prices rise. When the police pull you over, Vernon, because when they're at those speed traps, when they pull you over, do they pull you over because your car is moving forward, or do they pull you over because the speed at which your car is moving?
You are exceeding the speed limit on that particular road.
Yes, it's because we are exceeding the speed limit on that particular road at that particular time. They don't pull you over because of the speed you were moving 100 kilometers before that point. They pull you over because at the point they measured your speed, you were moving above the limit. They didn't say, we caught you in Chilanga here, because back in Kafue, you were moving at, no, that is not pulled you over. They pulled you over because at the point they were measuring your movements, they caught you over speeding, okay? That's an important fact. And this is why we speak in numbers, is because we want to use, because absent of facts, we use feelings. And feelings are a very bad way to make decisions. Very, very bad way. So the method with which the inflation rate is calculated should not, efficacy of the inflation rate should be measured according to, and this is me very, according to the price movements upwards. Okay, that is like saying car is speeding because it's moving forward. That is what you're saying. You're effectively saying moving too fast because it's moving forward, or you're saying a car is moving fast only because it's moving forward, even if it's moving at 10 kilometers an hour. Okay, even if it's moving at 10 kilometers an hour, you are saying that because this car is moving forward, moving fast. That is the logic by which we're saying that sentence actually is stated. And that is what people need to be very careful of. Let's speak in percentages. When we are professionals, as economists, let's speak in percentages, not in feelings and broad statements. Because I say again, that's how we watched it down to 2% amount allowed to generate electricity, because we said the car has a lot of water. What is a lot, Vernon? A lot. What number is a lot? This is the problem as a country. And that's why even in that article, it used the term, the problem with Zambia is we are functioning illiterates. And I go back to this problem. You may think I'm being harsh when I say this. This is the problem when your country is scoring 27% for math. This is the problem, because that's the baseline reasoning that we're using as a country. That's the baseline level of reasoning that we are utilizing as a country, and why policies are very difficult to pass. This is why you can't explain interest rates. This is why you can't explain investment. This is why you can't explain inflation. This is why you can't. The fundamental problem is that the people are being misled with broad statements and not that. So yes, we will ask such economists to come forward, but I will always remind people that the inflation rate is not the evidence of price movements upward. And it's not the one place you went to. It is the national inflation rate. That is like saying, Vernon, if you work in a company where people are being paid 50,000 kwacha, does that mean the average salary of Zambia is 50,000 kwacha? No.
Of course not.
It means the place you are working at is 50,000 kwacha. You have a data bias because of where exactly you are around. That is why we have a Zambia Statistics Authority, to make sure that they are collecting information on an aggregated level around the country. Remember that the inflation rate is not the Lusaka inflation rate. Okay, it is the national Zambian inflation rate. Down in Sesheke, up in Shiwangandu, in Chipata, in everywhere you go. That is the price of things changing and the speed at which those prices are changing. Okay, so that is what people need to recognize. What data are you debating? And the problem, I think, is even as professionals, this is why I keep saying, even as professionals, a lot of the problems we're facing is, one, because we are feeling economic pain and people are pouncing on it. We're feeling economic pain. We are not actually we're not being factual. Okay. Make no mistake, Vernon, I'm a human being. When I walk into shops, I find things expensive. It hurts, okay? It is an irritant, it hurts, okay? Maybe I react a little differently because I use that as incentive to go and earn more money. When I see the price of stuff moving up, I personally use it as an incentive to learn how to earn more money and to push myself to earn more money so that I don't fall into the trap of inflation and the political complaint trap. That's what I start to do. And that's what a lot of people should start to opt to look at as people, how to improve themselves financially. Because, and here's the thing that people may not get. Inflation also being a problem is also based on your income. In fact, the number one problem of Zambia is not even the price of things. It's the level of income and how slow income grows in this country. The problem in Zambia with the inflation rate is that, yes, on average, inflation moves 8 to 10% or 11% over the last 20-year spectrum, over the last measure. You see, I'm giving you numbers again. This is 20 years of statistics that we have been putting together since the year 2001, going month by month by month on CPI data, collected from Zamstats, collected from Luce, verified with various institutions to make sure that we were getting the right data. And what we have found is that the inflation rate moves on average 8 to 11% a year. Okay, that is what we're seeing. But unfortunately, when you look at the what we call the average salary data as collected by NAPSA, what we've been finding, especially over the last 6 years, is that the movement of wages has been stuck somewhere around 5 to 6%. Okay, especially in the last 5 years. Over the broad spectrum of time, the 21 years, wages are moving at inflation plus 3%. Okay, that is what they've been moving at. So they've been moving at inflation plus 3%, but this is mainly because between the year 2004 and 2011, wages moved fast. They moved up very fast. But now the problem is over the last 5 to 6 years, we saw wages slow down significantly to the point where inflation was moving faster than wages. Let me explain why this is very important. It's extremely critical for us as a country to grasp what the issue is. Switzerland is actually the country where the cost of living is the highest. But the Swiss people don't complain about inflation as much as the Zambian people. Why? Because Swiss people earn high salaries. So they can cater to that cost of living. That is the reality. Okay? So if you ask a person who's earning 100,000 kwacha a month versus a person who's earning 3,000 kwacha a month about the cost of living, you'll often find the strongest complaints about the cost of living are from the person earning 3,000 kwacha a month, not the person earning 100,000 kwacha a month. And as a result, one of the things people don't seem to understand is that income is a factor in this. Is that income is a very strong factor in this, right? That's a very important statement I think we should actually make. Okay, income is a very strong defining factor when it comes to inflation data. So if people have enough money to afford the cost of living, if people have enough money to be able to pay for things or the things that they want, then they'll be able to see that they'll be able to participate better in the financial. They'll be able to participate better not participate better, but they will not feel the pain as much. So the question of why should we look at single-digit inflation? Why do we target single-digit inflation was actually presented to me, and I think this is very important. The reason why we target single-digit inflation is because without inflation, we often find the producers of goods and services slow down their growth. You see, the thing people don't understand is that high-priced goods or higher than average priced goods incentivize people to produce more, okay? If the price of tomatoes goes up, more people want to farm tomatoes. If the price of maize goes up, more people want to farm maize. And if more people want to produce something, you know what starts to happen? More stuff is produced and more people are hired to produce those things. That's what starts to happen. So remember that inflation actually helps, a certain amount of inflation actually helps stimulate job creation. But what we don't want as a country is inflation that exceeds wage growth. That's what we don't want. That's what we have to be very careful of. We don't want inflation that exceeds the amount of wage growth. That is why we have the 6 to 8% target range that we have as a country. So we want our wages of our people to grow faster than inflation, but we don't want negative inflation, because when you go to countries like Germany and Japan, do you know what you start to find? You start to find that the economies are failing to grow. The unemployment problems, especially amongst the young people, is starting to rise. Those economies are starting to break because they've gotten to a point where there is no industrial growth. The levels of industrial growth are almost non-existent in those countries because they've been going through something called negative inflation, and negative inflation has disincentivized production. So that's where the problems are starting to come from if you start to look at inflation from that horrible light. The point is to have inflation that is lower than production. So that is lower than wage growth. Okay, and in order to stimulate wage growth, this must be solved by stimulating the economy to have more jobs. And more jobs are created when more people open businesses, grow their businesses, seek employees, because those entrepreneurs have run out of their 24 hours to be able to do that. Okay, I don't know if that makes sense now, Ben.
Absolutely, absolutely, it does.
Yeah, I know that. Yeah, look, let me be frank. Whether it's the people who I work with, whether it's the people who I speak to in public, I don't mince my words. Okay, if I'm frank about something, I'm frank about something. I'm not moved by political rhetoric. I deal in facts and numbers. Okay, I deal in facts and numbers and data. And that's what I do every single morning. I come here and I collect data. I know what the kwacha is and what percentage it's moving at and whether it's overbought or oversold, simply because I actually collect information, run that through calculations, and run facts. Okay, I don't tell you how I feel about the currency. I tell you the facts about the currency. I tell you the facts about inflation. I tell you the facts about finance. I tell you the facts about stuff, regardless of how I feel. And that is called being a professional. And if people aren't, and that's the reality of life. We all have to be professionals because that is what this country needs. It needs more professionalism. The reason why we are in the indebted situation, high inflation situation we have is because we use populism. And populism often is based on what is popular, saying what people want to hear, saying what will emotionally rile people up, as opposed to telling them the truth so that they can make better decisions. And I'm saying this because whether it's economists, whether it's news, whether it's doctors, whatever it is, we need to start, and engineers, we need to start speaking in facts so that the people of this country can trust the people who are speaking to them again and not always have to look at them with a side eye, hoping, wondering what is their motivation? What are they trying to get at? Because we have wrangled ourselves in making everything political as opposed to just making things factual. Okay. If we make things factual, we will be able to get better. But again, that requires also educating our population in order to be improved that. And people may not like me saying that. You may find it elitist, you may find it all sorts of things. But tough, that's how things are developed. You want to realize how countries get wealthy, sit around the wealthy, talk to them. And you know what? You'll start to realize wealthy people don't deal in feelings, they deal in facts, and they make hard line factual decisions every single day. Okay, life is hard, but they make very hard line factual decisions. That's how they got where they are. That's how they stay where they are. That's how they grow from where they are. And that's why the rest of us are stuck where we are. Right, Vin. Right, Vin. And something else I wanted to just quickly break down before I get into the next part of the wealth matrix. I don't know if we have any other concerns and things from today before we shift into the wealth matrix. I think we've lost Vernon for the day. Is something I want to share. It's just some data that was collected as a preamble to things like FinScope. The FinScope data report actually shows that is what we do to actually assess what we call financial inclusion and financial literacy levels of our country. Now, I've just done something quickly here because I'm trying to also look at FinScope data regarding at FinScope data regarding our financial participation levels. Now, this is something that has been of concern to me, and the rest of you will probably see it somewhere on my page, but this is what we call wealth product uptake in Zambia. The reason why we're clearly looking at things like wealth products in this country is because most wealth is built in wealth products. Most wealth is successfully stored in wealth products. I know that a lot of people participate in the property sector as their main way of building wealth, property and livestock. These are the two main ways that we've seen a lot of people building their wealth in this country. But in terms of mainstream methods of financial participation, I am going to look at financial products and how lowly there is an uptake in Zambia. And what you often find in wealthy nations is that there's this high level of uptake in these products. So away from the statutories, I looked at wealth products as percentages of Zambian adults. And here's some of the data that we are seeing. Health insurance, 1.71% of Zambians have health insurance. Obviously, NEMA will probably help with that. The rise of it will help with that because it's mandatory. And the more employers comply with NEMA, the more we'll probably see people there. But what I've done for this purpose is I've removed statutory social security schemes, things like NAPSA and NEMA. Those are not things that are voluntary. These are statutory. And therefore, let's look at things that are contractual and voluntary. What we're finding is only about 1.71% of the population has health insurance. What we're finding is 1.38% of the population has life insurance. What we're also finding is 1.34% of the population of adults has funeral insurance. That means one in every. Basically, let me put it to you in this way. Basically, about one in every 70 or so people, 75 people just being vague to try and put it, but 1 in every 70 or so people, when they die, have insurance to take care of their funeral needs. Okay. Then we got 1.26% people who outside of NAPSA actually have an occupational pension. Okay, 0.6% of the population has capital markets investments. In other words, investments in unit trusts, investment in brokerage funds, investments in different things. And 0.3% of the population have got savings plans and insurance plans for their children's education. So already what we're seeing is nobody, and I do understand that about 75% of our population is not formally employed, and 80% of our population, in fact, 88% of our population is living in poverty. But let's even look at the 10% who are out of poverty. Let's look at the 80%. Let's look at the 25% of people who are salaried. Even out of the 25% of people who are salaried, what this data is saying is that only 1 in 25 people, only about 1 in 12 people or 13 people have health insurance. What this data is saying is 1 in 20 people have a pension. And a pension is probably where, and a pension scheme or a pension fund is where people majority build their millionaire wealth. This is why this lack of financial uptake, even amongst the urban, highly educated, or the urban, the urban salaried paid workers, even amongst those people, this is already an issue. Okay, that we already have low uptake and low literacy levels. This is why I said the last time, Vernon, I said that as a country, we are financially literate, but wealth illiterate. That's a big difference that we all have to pay attention to. This is data gathered from the 2020 FinScope data and was derived and recalculated to show this. I say this again, people. Sorry, yeah, there we go. I say again, data, statistics, facts, things that we have to kind of work with as a country, right? Data, right? It's a very important terminology. So I just wanted to put that out there for people to see that as a country, one of the biggest concerns is that we may be literate in how to spend money. Unfortunately, we are illiterate in how to store and invest money. And this is what we need to fix aggressively as a country. And this is the battleground we need to stand on, and how to get people who, when they make money and they manage their money, they learn how to multiply and maintain their money using financial markets. The purpose of financial markets, Vernon, is not to help you make money. The purpose of financial markets is not to help you manage money. The purpose of financial markets is to help you multiply and maintain your money. Okay, that's where the purpose of financial markets is. The purpose of the job market and the business market is to help you make money. The purpose of personal finance is to help you manage money. And the purpose of financial products and financial these technical issues keep coming about, but we will overcome. We will overcome. There is a struggle here. I don't know if you can hear me now.
Loud and clear.
Right.
I can get you.
Okay, so now let's get into our financial matrix.
Your mic is muted.
Mic is muted because it just kept going on.
Okay.
Yeah, we'll just continue having this problem. But sorry about that. So let's continue, Vernon, down the wealth matrix. Yesterday we were looking at people, or the investment matrix. We're looking at people aged 30 to 39. If you are in your 30s, especially above age 35.
All right, so Mtwala seems to be having a bit of a challenge there with connectivity and technical issues. I hope he's back in it. But of course, remember that this is still on Money.
Sorry, Vernon. It appears that we're gonna have to change the. I don't know if you can hear me. Yeah, we're just gonna have to change how things are working now. I think we've just given up on the microphone, but I think you're also lost as well.
Sure.
All right. Just give me a confirmation, Vernon, if you can hear me loud and clear.
Loud and clear.
Okay. So I'll take that as a confirmation. Right. Thank you very much. So let's go through what we call the financial matrix from age 40 to 49. Age 40 to 49, the person has got less bang for their buck. But I just want to quickly go back to 30 to 39, actually. 30 to 39, your wealth multiplier was sitting at 28. Right now, your wealth multiplier has dropped again. At this point, you're expected to actually be heading towards the million kwacha wealth status. If you've been starting your journey from your 20s or at least your early 30s, you should be heading towards financial security, meaning your financial assets should be heading somewhere towards 1.25 million kwacha. That's what you should be doing. So what you should also be doing at this point is also looking at the fact that if you want to have millions, every million kwacha you want to have in wealth by the age 65 will cost you about 620 kwacha worth of savings and investment to be making. If you're looking at starting somewhere in your 40s, so it's going to cost you about 970 kwacha to be making. So you want to really check, are you in hyper accumulation phase? Are you starting to get a financial advisor and a wealth manager? And you need to know where your knowledge limits are. If you really want to make something of yourself at this point, you need to start knowing what are your knowledge limits. What do you know? What do you not know? Okay, those are important things that you want to try and grapple with. So what should you be looking at now in your time at this point when you're in your 40s? If you're in your 40s, what you should be looking at in terms of your investments, in terms of your time investments, you need to spend time now planning the vision of your life. Okay, because the vision of your life is what's going to inspire you to make good investment decisions. So, do you have your vision plan? I know that people think this vision mapping thing is airy fairy and so forth, but the reality is those 3 L's of your life, the vision of your life, your legend, your lineage, your legacy, and your lineage are very important in understanding what is going to drive you to make the sacrifices and continue making the sacrifices. You need to start going through purpose finding exercises. What is your purpose in life? That's a very important question to be answering somewhere in your 40 to 49 phase. This is where you should be. You need to start creating true financial wealth that is customized to you. So before I was giving you standard numbers, I was giving you basic things. I'll tell you the level of wealth is this much, the level of wealth is that much. When you cross 40, you need to say the level of wealth I'm targeting is to be able to have an income of, I'm giving you an example, 30 to 40,000 kwacha per month, because that is the lifestyle I want. Or you should be able to say, I want a lifestyle of 10, 15,000 kwacha per month, or I want a lifestyle of 90,000. And you're basing it not, Vernon, on how you're feeling, but you're basing it on your track record of economic performance in your life. That's what you're basing that figure on. Okay, that's an important differentiation to make. Part of what we should also be looking at around this time is you need to take your health seriously, because the biggest risk to your wealth is going to be your physical health. When you cross 60, your biggest expense is going to be constantly going to the doctors. So at this point, are you doing health checks annually? If you can, you need to go and start doing health checks annually. Start screening for the things that could possibly take you down and possibly be a big cost in your life. Because trying to fix a sickness is much more expensive than trying to prevent it or trying to treat it. In fact, Vernon, one of the biggest problems Zambia is going to face in terms of the cost of living and in terms of probably the biggest debt that we're going to find, the biggest national debt bubble that's going to grow in the next 20 years, according to a Washington study, is the fact that more Zambians are transitioning away from the communicable diseases, the things that will kill you instantly, like malaria, or waterborne diseases, those things that will kill you. They're now dying of the terminal illnesses, the cancers, the diabetes, the hypertension. These are the things that they're dying of, with things that were youth lifestyle decisions that have now metastasized into full-scale illnesses that they're trying to treat and manage. And we even saw the Minister of Health last year cite her concern with the growing number of cancer deaths that this country is facing. Now, treating cancer is very expensive, people. It's a very expensive thing. Okay. So, what other things? But one of the things that helps in treating these things in a much less expensive manner is early detection. So, investing in early detection, and I'm going to call it an investment because it's what's keeping your body alive. Investing in early detection by getting health checks, should you be able to have wiggle room in your budget. You can get by with a health check between 1 and every 3 years, but it's advised annually. Men, especially. One of the biggest problems is men only go to the hospital when we are dying. Okay, that is the problem. Men tend to do this. We go to hospital when we're on our deathbed or when things are too far. Women have a tendency to go to hospital regularly. Maybe it's got to do with reproductive health and issues like that. Yet women have a tendency to go to hospital more. And this is why they can pick things up faster, get treated better. Men need to start learning, especially in your 40s, that you need to fine-tune your car. You cannot service your car more than you service your body. And I mean service by going to get a health check. All right. So you need to be intentional about looking after your health. Invest in family building memories. At this point, your children are probably growing up and you will be struggling with loneliness because you've gotten to this point where maybe you have children who grew up, who you had maybe in your 30s or your late 20s, and they're getting ready to leave your home. And by the time they leave, they're going to take away with them a lot of the time they consumed, a lot of the purpose of your life. And one of the things that will live with you for the rest of your life, Vernon, is the memories you make. There's an old song by Mos Def, which the lyrics go, memories don't live like people do. They always remember you. Whether things are good or bad, it's just the memories. Yes, people, I love hip-hop music. But the beauty is he's trying to say that memories are the things that we carry. I have a cousin, Vernon, who's a photographer, and he charges quite a lot of money. And, I asked him, like, how do you sell to people? And he gave me his sales pitch. I think it's the most phenomenal sales pitch I've heard. And he said, tomorrow after your wedding, the food will be in the toilet. In fact, probably tonight. The decor will be back with the decorator, and so many things will be gone. The venue will be back in the hands of the venue, the venue provider. The entertainer will be back living their lives. The only thing that will stick with you and possibly even last longer than your marriage are your pictures. Okay? And Vernon, I was laughing about this, but I was looking at a picture. I think everyone knows, unfortunately, what I went through last year. But I was looking at a picture, and I still have my wedding pictures. Even though my wife's late, I still have my wedding pictures. Okay, because those wedding pictures I even have the engagement photo shoot that we took back in 2015, and it's outlived her, and that will possibly outlive me. So the reality is, memories are things you want to build. And by this time, Vernon, you also want to invest in your 40s in making sure your career is structured. So in your 30s, you want to be on a career path. In your 40s, you want to be on a well-structured career path because you're heading towards the tail end of your career. Okay, your career is going to be over by 65, and you need to look at also what you're going to be transitioning into. So at this point also, where should you be putting your money? You should be looking at where can you have the minimal tax. Okay, you need to start minimizing your tax exposure. And also your target retirement is over. You need to now start having specialized retirement. Sit down with people who can give you a specialized retirement plan that looks at where you are going. Because yes, you've got your workplace retirement. Yes, you're doing some target age calculations, but where's the exact point? What is the exact allocation? What are you trying to avoid at this point? There's something we call dumb doctor deals. Dumb doctor deals is not an insult at doctors, but it's actually aimed at the fact that unfortunately, because doctors seem to be some of the highest earners in society, they are often fed the worst business plans. So when people come to you with quick money schemes or these easy money schemes, in your 40s, avoid those like the plague because recovering from that is very difficult. Okay? Avoid taking too much risk. At this point, you need to start dialing down on your risk tolerance. Getting into your 40s to your 49, you need to start dialing down. Your risk capacity is starting to come down as well. You need to justify your luxury expenses. Having luxury vehicles and luxury this and luxury that. Have you run the numbers? Have you done the calculation for the car that you have? Have you done the house calculation? Have you done the numbers to say, this is the right one I'm supposed to have? Because at 40, Vernon, you are no longer an impulsive child. You can't spend money because of how you feel in your 40s. That's for 20-year-olds who have just gotten money for the first time. Okay, but by the time you're 40, we expect responsibility, and you should be able to justify your luxuries by being able to show that you have budget room for it. And limit your limit workplace risk exposure. If you're one of those places maybe where you do have stock options at your workplace, in your 40s, you want to try and limit it if it's not a publicly traded company. If you do have stocks in a company that you work for, let it be a publicly traded company. Some companies are doing this thing called ESOPs, where they allow the employees to be able to own stocks in the company. And also stop abandoning investment accounts from old jobs. If you get an old investment account, maybe you've got an old pension fund, don't rush to spending it. You reinvest it in something else. And make sure you max out all the benefits you can get. So this is your 40s in terms of your investment map. How to invest your time and how to invest your money and what investments to avoid. And I hope that we've all managed to touch on that. And I know we've touched on some personalized points today. And I know that, yes, I'm not politically correct, Vernon. I'm going to say this again for people. I'm not politically correct, nor will I ever be. And I thank Mrs. Fumbeshi for giving me that latitude to be like that. Okay, I'm not politically correct, nor will I ever be, but I will always try. I will always strive to be factual. I will always strive to be accurate, and I will always strive to give people the best advice I can. There is something, Vernon, I'll just close with, which is called the Psalms 32:8 promise, which says, I will advise you, I will teach you the way to go, and I will keep my watchful eye over you. That is what I believe in when I do my work. With that, people, have a wonderful day. God bless. Thank you, Vernon, for being on air with me, and thank you to everyone who has followed and been with us. And I don't know, we'll answer the question, unfortunately, that was put on at the end for today.
Absolutely. Thank you so much.